And with today's gain of 93 cents a barrel, crude oil notched its biggest weekly gain for the year, and it is now at the highest level in 9 months. So how will the key elements pushing oil today play out over the next few months? Joining me now on the telephone from Houston with his insights is John Hofmeister. He's the founder and CEO of Citizens for Affordable Energy, and he is the former CEO and president of Shell Oil USA. He's also a CNBC contributor. It's good to have you on the phone, John. Thank you so much for joining us.
Well, Maria, I'm sorry my plane was late, but yes, we really have a mess on our hands with respect to the goes-ins and goes-outs of the oil market. Traders may love it, but consumers are going to hate it. You know, the fundamental problem, I think, is that we just did not plan for this in the United States. We didn't plan for the geopolitical uncertainty. We didn't plan for Asia's rise in demand. And we have a business-as-usual approach in the oil production side, mainly driven by government policy, and I'm fearful that we're going to face very high prices as this year progresses.
Yeah, everything just seems to be coming together at once. I mean, when you mention the geopolitical issues, let me get there for a moment, because Iran, I mean, is Iran or the improving U.S. economy, which is the biggest consumer of oil, along with China, the fuel behind the move in oil, do you think? And how would you expect the Iran debacle to play out?
Well, you're exactly right. It's all three interconnected, one to the other. The world's biggest consumer, the world's fastest growing country, so the U.S. and China. And then Iran likes nothing better than to play havoc in all of this. And that's what I think will continue as the year progresses. I think we will just get duck bites day after day after day from Iran that will play out as geopolitical tension. Iran would like nothing better than to send the West into a very deep recession, and high oil prices is a good way to do that, particularly, and I'm very critical of the last administrations, including the incumbent in Washington, for having taken just a business-as-usual approach to the future of oil production. And you know, the 2012-2017 plan that's been announced is nothing but business as usual. The Keystone Pipeline deferral, business as usual. You know, these are critical times, and we're not seeing the leadership that could enable this nation to take care of itself for a change.
Well, yeah, I mean, we don't have an oil policy. How about that? So, you know, John, we see a pretty big disparity in prices between West Texas Intermediate and Brent. Why do you think there's that spread?
Well, I think West Texas Intermediate is so bottled up that we have more of it than we can use. And so that compresses the price. We don't have the infrastructure to move it to the refinery system. And one of the reasons our gasoline prices are being so impacted is that the East Coast, you know, with the shutdown of the 3 refineries in the Pennsylvania area, that's going to cause more Brent-priced finished product to be imported into the Middle Atlantic and New England states. So you're going to see higher-priced oil products coming into the market because the Brent price is now going to affect American consumers more so than it has in the past.
I see. Okay. The EU has said it'll stop importing oil from Iran by July 1st if Iran continues to develop the nuclear program. Do you think that will occur?
Don't hold your breath. No, I don't. I think there will be so many waivers and exceptions because if the least of all parts of the world that could afford higher crude oil prices is the European Union, with all its other problems. And, you know, to take Iranian crude out of the market is just not in the interest of the European economy. I frankly think it'll be a lot of talk and no action.
Well, that would be, I mean, if they were to do that, that would be another sort of pressure on oil to push it up, right? So
absolutely.
It's positive if it doesn't. Yeah. Okay. Yeah, on one hand, exactly. It's positive anyway. So what about we're now approaching the busy driving season, so this is also going to add to the situation. Gas prices hitting a national average of $3.42 this week. A lot of people talking about $4, even $5 a gallon. Is that likely? What do you think the driving season looks like this year?
Well, I started talking about $5 in 2012 in 2010 because you just look at the U.S. failure to respond, and you look at the growth in China. Those two dynamics alone are enough to push oil prices, let alone all the other insecurities. But I think, yes, I think we're seeing the inverse law of supply and demand. In other words, our demand is down 6% year over year, and our prices keep going up.
Right.
That is a real contradiction, and it's very hard for consumers to understand. It's hard for policymakers to understand.
Yeah.
But the reality is we're at the mercy of the global markets, not at the mercy of our own contribution to those global markets.
Yeah, and with all this talk about fracking and all this talk about shale, you're still not seeing that impact prices. You're not seeing that impact things at all in terms of the expectation that you've got more supply.
Yeah, that's really just a trickle in the scheme of things, because don't forget the Gulf of Mexico has been declining because of the moratorium and the absence of drilling.
Right.
So the trickle of shale oil doesn't make up for the losses in the Gulf of Mexico. Net, and a lot of what the government is counting as liquids produced, saying we're producing more, are really natural gas liquids, which do not turn into gasoline or diesel. So there is a production upside, but it's not helping the gasoline or the diesel market.
Understood. John, good to have you on the program. Thanks so much.
Thanks, Maria.
We appreciate you weighing in. We'll see you soon.
Bye.
John Hofmeister. Let's take a look at the other business headlines tonight.